Good morning, everyone, or good afternoon, as the case may be. Welcome. We're about to start the morning or the presentation for today, the title of which is Examination of the Bond Market. My name, as you see on the screen, is Glenn Thompson. I've been working as a mentor with Pacific Trading Academy since the beginning, since its inception 15 years ago, roughly. I have a long time of teaching and consulting. We've been doing webinars for, I guess, 2.5 years or so now, and happy to be with you again to share with you my most recent insights concerning interest rates in the bond market. If you have questions beyond the scope of what I can address in the presentation today, you can contact us and me, at least indirectly, if not directly, via the contact information. You can access our website, www.pacifictradingacademy.com, as well as the toll-free number 800-339-8588. We are, as I mentioned when I first came on about 3 minutes ago, recording today's session, so if you'd like to review it or access or replay, we can do that. If you have questions as we proceed, you can type them in on the right side of your screen in the control panel area. If I'm unable to address them, or if I don't see them during the course of the presentation, I can hopefully, I'm pretty sure we'll have time at the end to kind of give a little more of a response. And again, welcome. One other thing I should mention: if you do contact us or have interest in our programs or want to get more details about anything that collectively we do as an institute or an academy, and or specifically what I do, the person to reach is Peter Newman. He's the individual who handles admissions and can give you greater detailed information and feedback on the programs that we provide. Again, examination of the bond market. So let's proceed, and let me just see if there are any other questions. All right, good. If at any point, folks, I lose you, every now and then we have a technical glitch. Hopefully that will not be the case, but if so, just you can indicate, let me know so I don't keep going without you present. But barring that, we should have no problems. All right. And timing is big for me in terms of the analysis that I do. You can, good, thank you again for the feedback there. You're able to see. When PTA, when Pacific Trading asked me to do a webinar, I was hard pressed. It's been about a month. Normally I do about 1 to 2 per month, but I think I hadn't done any in a few weeks. So I wasn't quite certain what to do and what topic, and I like to select topics that are relevant to what's going on and where my focus is in the markets. I trade derivatives. I'm a technician. The slide here is timing should always take precedence over price. That's not a generally held view. It's my view. That's not to say I don't incorporate price analysis. I do all the standard analysis. I'm primarily a technician, so but timing as a causative agent is critical and a focal point of what I do. And those of you who've heard me speak or know anything about how I generate signals and the particular approach I take understand that. So I just wanted to do that. I am short the bonds from, I guess, a week or so ago. I'm a little behind on that position. Obviously the bond is the nominal inverse or mirror image of the interest rates, but here's the point I want to make. When I realized that I was going to talk about the bond market or interest rates indirectly, for a day or so I began trying to figure out how to forecast interest rates, and I came up short, and I kept going, through one line of analytical path to another, and really couldn't figure it out. I could, 6 reasons why I thought interest rates will go up, another 6 equally good reasons why I thought they would come down, and another 3 or 4 as to why they might remain stable. And it occurred to me that, again, I was regressing to what I used to do more than 30 years ago when I started my career, and that's try and predict and forecast and anticipate the Fed. Good luck with that. So it just dawned on me to take an opposite tack, and that is do what I do and have been doing for more than 30 years, and that is start from the charts, allow the market to guide me and be more or less a facilitator by which I can reverse engineer and at least more probably get or become aware of some plausible pathways and courses of action on the part of the central bank in terms of interest rates and where they may go and where they may head. So my nightmare was over. I didn't have that analytical quandary in terms of how to figure this out when I do and play to my strength, which was to look to the charts. That being said, I do want to take into account these intermarket correlations that sometimes are present. This is standard intermarket analysis, just the basics, and then during periods of deflation or inflation, you see some decoupling or decorrelation of some of the standard relationships. But more or less, this is the starting point. This stuff will work, I don't know, 67, 70% of the time as a starting point of examination of some of the things. You know, why are the bonds important to look at? Why are interest rates important to look at? Because it's money, it's energy. All of the financial sectors, and then in turn, all of the other markets, ultimately, again, from a fundamental perspective, start with money. Capital flows determine the course of the equity sector, and our economy. So it's of critical importance that we have a bead on the trajectories of interest rates. So that's essentially the thrust of what I want to talk about, and how this translates into some plausible, high probability value areas that we could exploit for good trades. I think I'll talk to you about. As I said, I got short in the bonds in the 30-year Treasury about a week and a half ago. We are currently a little behind on that, so I'll talk to you about that by the end of the and how we're going to resolve our way out of that. The varying if-then situations that I see are the best courses to take. But this is a slide that I'll come back to and refer to because it plays into everything. When I make an investment decision, I want to take into account all of the relevant, salient, important, relevant pieces of information I think are going to play into that. Money flows towards the greatest rate of return, just as a backdrop, and so the bonds are immediate receptors, if you will, of large capital flows. So we got to keep that in mind. Okay, here's the first thing I want to substantively present to you, and it's the interest rate spectrum and markets are very pure as a technical vehicle to trade, an instrument to trade. And this is a weekly going back a few years, 2011, between 2011 and right now, and this is textbook wave structure. Oh, by the way, folks, for those of you who are beginning or don't understand Elliott wave, I'm not intending to. This is not a webinar on any particular model per se. For me, the hierarchy of tools and methods and models that I use, number one would be pure trend analysis. A close second would be projections like Gann analysis, time price equivalency, and time projection models. And then third on the tier of my totem pole of importance would be a very large price model such as Elliott. I think it's a very robust price descriptive model. And here is, again, the weekly chart of the 30-year Treasury bond. And you can see it doesn't get much clearer than this unless it does. This is a weekly, this is 1, 2, 3, 4, 5. That's your bull market phase of a cycle, and then that's wave 1, your bull, and then your bear, your ABC three-wave correction. Here's your A, your B, your C. All right, so that's the history, and then more recently bringing us through the present. And the whole point, because I hear sometimes, you know, an oft indicated criticism of the Elliottite paradigm is it tells you everything you want to know about the past is less helpful as far as forecasting for the future. Well, anyone who would say that is kind of not missing the point. You can make money by virtue of having a solid, comfortable, and confident understanding of where the market is at any given point in time. I don't necessarily have to have an explicit prediction of the future to profit. Versus that, or alternatively, or at least complementary to that, if I have a sound understanding of where the market is, I have a better context as to, you know, how I can expect it's going to move. So that's the fundamental idea. The other, well, yeah, I'll leave it there. So this is the end of the one cycle and the start of a new cycle. And here's your second bull market phase. And I think we are currently in the ABC portion of the bear market. And that's why that goes a long way. The Elliott description, as indicated and illustrated on this screen, illustrates or is a major reason why I adapted the short position that I have in the bond sector right now. And so that, of course, implies, there tends to be an inverse relationship between the course of interest rates, the nominal interest rate, and the nominal price of your 30-year Treasury or the 10-year. It could be anywhere on the time curve on your interest rate spectrum. But 1, 2, 3, 4, 5, this top here clearly indicates the end of the bull phase and the start of the bear market. So here's where it gets a little dicey, folks. In terms of more precisely, and life is never easy and quite crystal clear, regardless of the models. I always tell people, whether you're using trend analysis, something like Ichimoku, candles, trend lines, whatever you're doing, these are just collections of ideas which collectively we call models. But a model is just that. It's not gospel per se, unless it is, and rarely is that the case. Every now and then it gets it right. And these are paradigms and constructs that market researchers and scientists and people who investigate markets and traders and investors alike have over the years figured out, evidence certain correlations that we can depend on to some extent, and thereby provide varying amounts of edge, which when applied, provide the analytical portion of what it is we do, and then we couple that with other stuff like money management. But if this is the fifth wave, everything to the right here is I believe, correction. And so if this is an A, we know that corrections typically take place in 3 waves, A, B, C, and then that completes a given cycle of, and then a new cycle commences. So if this is the A, this move up here to this recent top would be your B, and I would expect, theoretically, I would expect the market to come down in order to form the C, and that would have it somewhere in around the 140 area, again, relative to the 30-year Treasury bond. This is the December contract at continuation weekly. All right. The only issue is it's not so neat. Notice we have this little pivot point here and then bringing us through the current price. And that further complicates it. Now, can I, in this still accepting that this count is accurate and valid and an accurate description for what's going on, can this little pivot point right here for the last 2 weeks or so, or no, excuse me, this is a weekly, 1, 2, 3, for the last month and a month or so, a month and a week, going back to the beginning of, say, September or second week of September, can we incorporate that into this? Can this still be a C? The answer is yes, as long as this price doesn't take out this top here. Otherwise, all bets are off. And then I've got to go to an alternate wave description, which might be, for example, that instead of thinking of everything from the end of the bull market, the top up here, number 5 and big letter 1, big super case exponent 1 here, if instead of thinking of this move down as just the A of a 3-wave larger ABC correction, it's possible, I don't happen to think the next scenario is the case, but it's possible, I can't rule it out, that this entire move from here down to the A is the entire 3-wave ABC correction in and of itself. I can see the inflections here. This could be the A, this could be the B, and where I have penciled in or drawn in here labeled as A, that could actually be C. In which case, if that's the scenario to which the market is responding and is moving on the track that it's on, this would be wave 1 of a new bull market. This would be a wave 2, and I'm certainly on the wrong side of the market in that case. The move up for the last 4 or 5 weeks or so would be the start of what would be a wave 3. That's going to take you off the screen to new heights. And that would certainly be consistent with a low interest rate environment. I have been telling people as a side note here, that I'm not surprised by the delays on the part of the central bank in raising interest rates. If you ask me at this moment, I don't expect that they will raise rates this year in 2015. I expect we may see an interest rate hike first quarter or so of next year, but I don't expect fundamentally the policy. I think we will continue to have accommodation in terms of money and money supply on the part of the central bank, and that's my view. And so that would certainly be supportive of rising nominal bond or treasury prices, treasury instrument prices. However, I do think, again, I don't think that that's the wave count. From a proportionality standpoint, look at the past. History tends to repeat itself. Look at the past. This is one cycle from this bottom here, the start of the bull, up to here, and look how long and extended this ABC, the bear market was. Now, it doesn't mean that history repeats itself necessarily to the letter of the law, but the semblance of formation and structure tends to, nothing new under the sun paradigm. And I believe that that will happen. Now, there's a difference here overall. What I consider to be a primary cycle, from in the context or lexicon of Elliott model, would last on anywhere between 2 and 3 year period. So if this is one, this is from 2011, the start of the cycle, through the middle of 2013, or beginning of 14, I forgot where that is exactly, the end there, that bottom, but more or less 2.5 to 3 years is the historical precedent. Now, one cycle does not make a large enough sample size by which to evaluate and forecast and project the future. Nevertheless, it can, because of the purity of this market. Notice how pure and textbook-like that is relative to its theoretical attractor. And here, there's an obvious difference, though. Look at the amount of time for the bull phase of the previous cycle relative to the current cycle that I think that the market's in. Much more extended in time bull phase. Is it possible that there's an inverse relationship in the amount of run time between the two phases of a market cycle, the bull versus the bear? That's why I've titled this slide the bull-bear tug of war. It's an interplay between bull and bear. It's possible that because this was more extended, given an average total amount of time for a given cycle, 2.5 to 3 years, that this could be shorter. And that would be an argument for anticipating that this is the entire ABC correction. We have this bottom here already marks the start of the next cycle. There's a possibility. I cannot rule that out. Can't rule it out. But I am short the market, so that I have put my money in positions that represent an alternate view, and that is, again, that I think we're going to have that we are still in the midst of a bear market that began with this top right here, and that this is just an internal blip, a subdivision, if you will, of the C wave. We know that A and C waves, the motive waves, if any, 1, 3, 5, A and C, should always subdivide and have 5 internals. I believe that according to that this move from this top here to this bottom is the 1 of the larger C. This would be the correction 2 of the larger C, setting us up for what would be another decline, possibly into the 145 to the 140 area in terms of nominal Treasury bond prices. And that would complete the bear market, after which I expect, given the low interest rate environment and possibly further declining, I don't know about declining, but I think on the 10-year we may see further declines between now and the end of the year of interest rates, would tend to be price supportive of the 10-year note specifically. But we may see a little of that even in going out to the 30-year Treasury. But overall, that's my view, and that would certainly suggest near term. When I say near term, between now and the rest of the, where are we? Today is the middle of October, October 15th, October, November. For the remainder of the year, I see that the Fed, based on this, my selected and first choice wave count and description, that provides a bead for me by which I can attempt a projection as to how I expect and what I expect to come forth and emanate forth from the Fed. We're already hearing Janet Yellen and the Fed in general for months now has said that they will affect policy that is data-driven. We've got a report coming out this Friday, the unemployment report, I guess, Friday morning. So based on that, we shall see. However, I believe that there are more pros to delaying increases in rates further rather than the cons overall. So that, again, that in and of itself is bullish, but I just expect for technical factors, we are still in this correction. If I'm wrong, and consistent with what I'm saying, I expect will be the longer term policy of the central bank, that certainly augurs for higher bond prices. So here, and so the next slide will indicate my acid test by which, from a trading practical standpoint, we'll know what to do. And if I should exit my short position, SAR, stop and reverse and go long sooner rather than later, or is there still life in the bear, which the charts clearly suggest there should be, and is. Okay. Again, so my favored count right here is that everything from the top, the end of the bull market, the top here where you see number 5 and the subs in the superscript number 1, indicating that's the end of the bull market phase of an 8-wave multi-year cycle here, is and the start of the bear market. I believe we are still in the bear market. This would be the A wave. Everything up to this top is the B. Everything from this top here through where we are at the present moment is a, albeit an odd-looking or atypically formed C wave. But here's the acid test. We take out this high, this top right here, the point that according to this current wave count, suggests is the end of the B of the bear market, the B wave of the bear market, and the start of the C. If that top is violated, then I will quickly revert to my kind of fallback count or description. That would mean possibly that this was the end of the bull market, or excuse me, of the bear market, where I have letter A. In fact, it should be relabeled C, and that everything subsequent to that, to the right of this point of A right here, that marks the end of that cycle, and as such the start of a new bull market cycle, in which case this would be wave 1 going up, this would be correction 2. That's a slightly, I don't like that as a wave 2. 2s tend to be deeper, but I can't rule it out, and that would mean that we are just getting started in the formative stages, getting out of the starting blocks, if you will, of a wave 3, and that would present a tremendous opportunity, and that would be consistent with my projection of expectation in terms of policy that I expect to emanate from the Fed, that they will not raise interest rates until possibly the first quarter of 2016. So that's the chart enabling me to get some insight on an otherwise unwieldy, kind of fugitive, task of trying to project and predict in advance what's going to come forth from the Fed. We got Janet Yellen, I think, who, as the head governor, wanting to, I think she's leaning now towards a sooner, but we're getting some dissent from some of the other governors. I just read a report yesterday that some of them are of the feeling that there should be a further accommodation. So internally, we'll see how this all resolves. And again, on the near-term horizon, the report that comes out tomorrow, that's right, today is Thursday. Okay, tomorrow morning, we'll see what the jobs report indicates. All right, next slide. This is a way out of that conundrum. Sometimes when you're trying to decide within the context of a particular model, different plausible interpretation, sometimes you need to look outside of that model at something completely different, so as to create a differential that would effectively tip the balance of interpretation one way or the other, bullish or bearish in this case. Excuse me, folks. All right, this is the daily chart, same chart, just the daily, a little more detail, granularity here. This bottom right here, this bottom June 26th, if I recall, this lowest point on your 30-year Treasury December bond contract is the same data point as the previous slide. That's what I've marked as point A right here. Same one and the same data point. I forgot the price level somewhere. You can see 146 or something and change. We'll get it on the next slide again. But I just wanted you to see, so you have context. We're moving down in scale from the weekly down to the daily. This is the point that I consider, with my current wave count, that's my number 1. I'm allowing for the possibility that this could be the end of the entire bear market ABC, but I don't think so. That's my second favorite count. My first choice is to label this as the end of the A of an otherwise still progressing and ongoing bear market. This would be the B up here. I didn't put that in, and everything since, and we are still in the C, the net effect of which I expect will take the market down somewhere between 145 and 140. Given that, look at the magnitude, look at the percentage degree of retracement in the previous cycle. Look how deep that was. Look at this A, B, C. Oop, I didn't mean to. Okay. Look how now that's inordinately deep for a bear market. Not out of the pool, not out of the ballpark. It usually, I would have expected it to end up in here. Usually ABCs in their entirety are bounded by the preceding wave 3 and 4. This was a little deeper. That's so being conservative, using that as a precedent historically for what the future could hold, I would expect there is further declines in the offering. Here, this actually this is probably misleading. This is 3, 4. This is the end of 4. I should have had the 3 here. This is an irregular correction. That's a finer point. I don't want to get caught up on that. What's important is this is either A, this data point, June 26, I believe is the date, or it's a C. If it's the A, I think there's more downside and further stability in interest rates, but a delay of any hike to come. If I'm wrong on that, and this is in fact the end of the entire bear market, that would be way out of sync with the historical Fibonacci proportionality and the tendencies that we've seen in the past. That's a major reason. It's a subtle point, folks, but it's a major reason why I still expect that we are still in the midst of the bear market in nominal bond prices or treasury prices, and as such an accommodative atmosphere in terms of interest rates, a bear market as far as rates are concerned, let's say. And I still think that there's more life in the bear from the standpoint of interest rates. But if I'm wrong, then this does, this is a rather shallow, by all modicums and metrics, and a bear market. Then if in spite of that is the case, this would be letter C, and everything since then is a new bull market, in which case we would certainly give credence to the long side of the market. Okay. So, okay, again, let's for now assume that this is just a component, the first stage, the first leg of a bear market, the A wave, and that brings us back to and so this is everything up here. This is say everything from the bottom, June 26 here, you can see exactly at the 146 price level in nominal 30-year treasury prices, up to this top, I think, is the end of the B wave, and everything since is a C. Again, admittedly, I don't typically expect to see this. However, it is consistent with all features and attributes that are peculiar to this model. We're not breaking any rules, unless and until we take out the B. If the price continues to rise, and we have today, this is printed out last night, but today's action is just an inside bar so far with respect to yesterday. It's an inside, which by itself tends to correlate with continuation, which would be somewhat bullish. Here's the point, bottom line. As long as this top right here, the point that my current first my preferred wave description is indicating marks the end of the B wave, the start of a C wave. As long as that's not taken out by the price, I still maintain we're in a bear market environment in the nominal price. Now, here's what I have going on down here. Look at the red line. That's the commercial activity. They are responsible for about 70 to 80% of the volume of activity going on. Notice this is tricky. It's a very atypical relationship exhibited between the commercials, the large and small traders here. The red line, they're net short, albeit by a small amount relative to where they have been just at the end of September. That's around September 28th. This is a report that comes out weekly. Tomorrow is the next report, so we won't know the new data, how this red line or how any of these positions will change until tomorrow's report is released. But they're still net short, but you can see for the last few weeks they have been decreasing their net short position. If they continue on that course, they will inevitably go net long. And then they'll be aligned with the blue line, which is the small traders. That tells me they get as long as these small traders, as reflected by the blue line, are long, that's 85% of the time they're wrong. So the small traders, or specs as they're referred to, are long the market. And that's referring to the nominal price of the bonds. That is probably that's another small by itself, but a component I want you to take care of or take into account. The fact that they are long, and both the commercials at this time and the large institutional money, that's the green line, the large specs, are nominally short, even though it's not by a great amount. They have been over the last course of the 4 weeks or so decreasing their net. They have been decreasingly short. They are still nominally short. That means to say the big money right now in the market, for the most part, expects that they're concerned, their fear is falling bond prices, not higher bond prices. That's the current stationarity. That's the current snapshot of the view as of last week. That's the most recent report. Information is incorporated into this picture. We again won't know the latest change, if at all, until tomorrow. It is what it is. So here's my thought. If we still see, as a result of tomorrow's report, if we see the big money, the commercials primarily number one, and the large institutional money on the lower side of zero, if they're still net short, while at the same time the small traders are net long, that's a strong argument that we want to stay in our short positions and be, for the moment, even though for the, over the course between now and the remainder of the year, I expect interest rate policy by the bank to be accommodative. And I don't expect, I expect further delays next time the Fed meets, and I don't expect we're going to see any rate hike until at least the first quarter of next year. There's just too much mounting evidence that would, there's not sufficient evidence to compel the governors to raise rates at this juncture. Now, this could change to the extent I'm allowing this completely alternative, disparate indication, the relationship of the various sectors or factions in the markets to kind of give me a bead on how to interpret which count or wave description is optimal and relevant and the most accurately describing what's going on in the day-to-day action. So I wish I could be speaking to you Saturday, the day after we get the new COT report by the CFTC, as well as after having digested and discounted the data that's going to come out tomorrow morning in the jobs report. But as it, that would make life a lot convenient or more easy, an easier route for me to kind of predict and give you my best bet on the trajectory for the bonds and interest rates going forward. But it is what it is, so we'll have to see. But those are the two fundamental events I think that are going to lead the way. What comes out in tomorrow's report by the government and also or reports, I should say, collectively, and how the market discounts that will go a long way in terms of determining the next immediate next course for nominal bond prices. So this is something that I'm looking at least to kind of provide a finer knife of differentiation in terms of what to do in my position. All right. Okay. Vis-a-vis the earlier slide where I said that I work from the theoretical standpoint that market timing is critical to the decisions I make in the trades that I'm and the scenarios and strategies and tactics that I employ. This is a set of, well, let me just check, guys. I want to make sure because I'm not seeing anything. Are you guys still there? Can anyone? Okay, you want to make sure we have everything in place here. All right, good. I think you can see this. Great. Thank you, guys. Thanks. Just wanted to, okay, if there's any questions, I know I'm kind of rushing through this. I want to make sure that we have time at the end for any more comprehensive redress. All right, great. All right, very important in just the providing a more complete picture. I always, just as a side note, guys, to qualify what I'm saying, when I say that I depend on my time targets, it doesn't mean in the theoretical sense. I don't mean I place trades solely on my time targets. I could if I'm really confident, but in the perfect world of putting and constructing a trade entrance together, or a scenario where I think I've identified a strong high value area in a market and I've got a good opportunity to exploit, I want to bring to bear my price analysis as well. The timing points, when they are reliable, simply indicate the point in time, or at least a window of time within which I expect a reversal to occur. When I get closer and closer to that projected time point, I then look and do my standard analysis of price. Does it look like I'm nearing the end of a wave? Do I see a pivot point? Do I see a resistance or support level? Do I see any and all price analysis? Is there a Fibonacci level? Is there a gap? Any and all of the things. Is there a price pattern? Is there a whatever one would find or feel is instrumentally critical and relevant to what's going on in the price action. And when, like Gann and people like him used to say more than 100 years ago, when price and time square, or when they come together, that's where you have the highest probability for a transition or a reversal in trend to occur. That's where you get your greatest degree of edge. So that's all. This is, I haven't indicated all of my past time targets, but just more recent. This is the last one. I purposely offset this vertical. These vertical lines, by the way, represent my time targets as indicated, and I have the dates on them going out into the future. This one, all of them indicate the exact times or windows of times. This one, I offset one bar to the right because to show you that the accuracy was perfect in case this October 2nd was actually this bar, this top that came in, so that you could see that it was a top. I offset it one day to the right on the next day, but it actually should be on this day, which a turning point. That was pretty good. That was pretty instrumental. This is the 30-year Treasury. Again, this is the 146 price, if I recall. That's the point, the end of coming down here. This was the At that time, we were trading in the September contract. That's why this is very sketchy. It was not all that liquid a contract at that time. But this moved down from the top. That top was the end of the bull market cycle, and everything from that top that was back in the preceding back here. This top was number 5 coming into point A, which is where the chart that we're on, the slide we're on right now. This is point A. The end, what I believe, according to my preferred count, is the first leg of the bear market, A, right here, and the top back here that would be off the screen in the upper left-hand portion would mark the end of the bull, wave 5 or the larger degree 1. All right, and then you can see if this is the B, you can have the 3 segments. This, I think, was the well, I can make a case for 5 waves in that. That would be the A. This might be 1, 2, 3, 4, 5. But in any case, that's of your. That would be the. Well, if it's a B wave, it should. This would be 1, and this would be 2, and this would be 3, because there should be the counter moves of any primary trend, bear or bull, should be moving opposite the direction and should break up into 3 little waves. But that's a forget that. That's not important to today's program. But what's important, this is the timing idea. This was perfect. This was an accurate forecast to the day, October 2nd. The next projected time target, for which I have a lot of confidence, happens, it just works out coincidentally or otherwise, it happens to be today, October 15th. Based on all of the different tools and projection models and methods that I apply, I worked out a time target for today. Now, about 10 minutes before I got online with you guys, I was looking at the chart, the actual live chart of the bonds trading, and so far, the current price, we were trading around 158.28 in the December bond contract, and it was an inside bar formation thus far today. Now, the day is still young. We still have a few hours left in today's session, but we were trading, as I said, around approximately 158, almost 159. But the high was still lower than yesterday's high, and the low was still higher than yesterday's low, creating an inside formation. And that means whatever it means. There are all sorts of ideas. It tends to correlate with continuation of what preceded it. So that would by itself, if it turns out that the range of action today such that we create or have a net inside formation, that's it's a small point to the bulls. I would give it that. That tends to correlate about 70% of the time with trend continuation of whatever the market was moving or what direction the market was moving in prior to the formation. But that remains to be seen. I'm just saying currently the latest data I had before I tuned off, and I don't have my other screen up to show where we're trading at the moment, but suffice it to say, we're probably nothing stupendous has happened. No great volatility thus far in today's session. All right. And by the way, the stock market was, I think it was down a little bit today. We were trading 2002 roughly in the S&P basis the December contract. So, but what's important is this. This is a turning point today. So if we form a top today, or if maybe I'm off by a day and this was a top, in which case, remember, based on the preceding slide where my preferred wave count, I am expecting, again, I am short, like at 157 and change. So I'm down about a point and a few ticks on the bonds, on my short bond position currently, just to kind of give you some context here in terms of what is at play, my current positioning, and my expectations theoretically for how I expect this market to moving out in the next few days, weeks, and months to come. So we are at a critical juncture. I don't. By the way, I could be. It's conceivably. Let's think about this. Have a little reflection. It's possible. It just hit me last night when I worked this. I didn't have 10:15. I did some work yesterday in preparation for today's presentation. I had not projected 10:15 until yesterday. Curiously, I had projected all these other dates. Obviously, October 2nd I had done weeks, if not months ago, before October 2nd. But I had all these dates worked out months, or at least a month or so ago. But I had not, based on some alternate ideas and, well, based on more recent structure. In other words, it wasn't because I just arbitrarily didn't figure this date out. Sometimes the methodology that I employ and utilize is dependent on the price action. I'm using the price action as the seminal seed from which I am able to generate sometimes pretty reliable indications. And what's becoming ever more meaningful is the possibility that the obvious. Tomorrow we got the jobs report and the commitment of traders again. Every Friday the COT comes out. Not every Friday, but tomorrow we have the unemployment report. So it's possible that this vertical line corresponding to today's date really is correlated very highly, I'm certain, with, it would probably suggest to me now I can play there, to expect something possibly salient in tomorrow's reporting. So we'll pay attention. I know expectations are for, I think they're expecting, I can't remember. I think they're expecting, on the order of 200,000 new jobs. I think that's the prediction for tomorrow's report. So we shall see. Referring to September is the data for last month. Okay, so we'll see. Unemployment, I think, is projected to be coming in around just over 5%. So we shall see. But this time target, I think, takes on special meaning given its proximity to the report that's scheduled to come out tomorrow. So we shall see. Aha. The next, okay, so I think that's an important piece of information to think about. November 23 through November 26. Of all these vertical lines on this screen, this is the most important, and it happens not to be a single day. It's a window of roughly 3 days. I am getting, using everything I know, in 30 years of learning everything I know, I'm getting more hits cyclically based on my cycle projections, based on Fibonacci analysis, based on certain GAN ideas and techniques, and all the varying harmonics of 90, all sorts of ideas that I use and teach and incorporate to generate hits in what we call time clusters. I'm getting the greatest degree of correspondence and overlap in this 3-day window. Curiously enough, and this is specific to the bond market, again, all of these vertical lines, they may or may not coincidentally apply to alternate instruments or markets, but everything is certainly specific to the 30-year Treasury. That's what I did the analysis on. However, it's not so obvious or not obvious. 11/23, I have also projected to be a date for the stock market in the U.S. Obviously, that makes perfect sense. They tend to be very strongly correlated, equity sector and the debt sector in our country. But 11/23 is a precise date I have for the S&P. Curious, I find it of interest that it also happens to be a part of the 3-day window for which I have the greatest amount of significance, and I would assign about, at least currently, 90% reliability to this 3-day window coming up in November. Of all now this was obviously perfect, that's the past, but this I think is going to be pretty important, again, given its proximity to the report that comes out tomorrow. We shall see, time will tell. I think these are, currently I'd give them about 80%. It's a little far out. As I get closer and closer to any projected time target, I more finely assess the degree of projected reliability and accuracy of them. But currently, this is like at 90%, these are probably 80%. But because I have the greatest amount of overlap and clustering, in other words, various techniques all happen to put me in this window. There's one date I'm getting 11/23 from an altogether separate technique that I apply, but this 3-day window I'm getting the greatest degree of hits versus all the other dates that I've got. And these are significant, as I said, about 80% likelihood that the market will turn on or around that point. By the way, those of you who've, these dates by themselves don't tell me, I don't know, and there's nothing intrinsic to the projected time points that the analysis generates to, in and of themselves, indicate whether it's going to manifest as a top or a bottom. All these do is tell me that to expect a transition. You see, so hypothetically, it's possible. Let's say my wave count that I utilized and indicated and presented off of the weekly chart is correct, that everything from this top right here, okay, October 2nd, which is came in based on my time projection perfectly. At the time I did it, I didn't know it was going to be what I'm trying to fit Elliott model with my time projection. Two different completely universes apart, trying to reconcile and dovetail and make sense out of it. Is this the end of the B and the start of a 3, or excuse me, the start of the C wave? In which case, if it is a C, the A wave, which would be this from all the way down here into this bottom here, and this would be the, I'm sorry, this is the B right here, not this October 2nd, this higher top would be the B, might this November time point possibly correspond with the end of the bear market C wave that began with this top right here, in August, or yeah, it looks like kind of the third week or so of August, August 24. If this is the end of the B, is it possible that this move down into this bottom here in September, October 2nd top, this is just internal fluctuations within the larger scale or degree wave C of the bear market, which conceivably, when I take a look at from a proportionality standpoint, could quite possibly end over here, given this highest probability time point in November. I'm just saying, because in turn, A and C of a zigzag type correction tend to be equivalent in terms of price, roughly. So that's quite possible. We shall see. The acid test is, as long as the price doesn't take out this top right here, this top August 24, the end of my count, preferred count is calling the end of the B wave. We are still seeing structure which is consistent with everything since then to the right being a C wave. If, however, we see an acceleration to the upside, a bidding up of prices to the point where we take this out, then I've got to alter my count. What I'm considering here to be the end of the A wave would in turn, I would reconfigure, reinterpret, possibly be the start of a new bull market cycle 1, in which case this would be a 2, the end of 2 and the start of a 3, and I'll quickly SAR, stop and reverse, and get out of my short and look to embrace the long side of the market. But that's just a possible reconciliation of my time projected data with respect to my favored wave count, you see, and we shall see. So that this can be very helpful as at least a complement to my price analysis. This is just a rehashing, just to remind us, okay, and there's a reason why I've got what I call Exhibit A coming up in the next slide. As commodities go down, okay, in general, bond prices go up, all right. As commodity prices appreciate in general, bond prices go down. This in turn is ultimately as a precursor to that, has the course of the dollar. I am currently bearish the US dollar, which would tend to, in and of itself, in an ambient environment where it's not in excess of deflation or inflation, lifts commodity prices and put bond prices down. So again, to rehash, my overall short-term scenario for the bond market, I expect lower nominal bond prices, but again, only until such time as until we again shorter term. I am possibly out into this time frame in November, into the middle. That's the projected time frame. This projection, and again the amount of confidence that I have in it currently, gives me some modicum of sense or ideas to how long the run time for which I can expect interest rates to, or the Fed at least minimally to be accommodative, such that we can continue to have be in this bear market. After which, I expect as we move into the end of the year, but more realistically, I expect not until next year, 2016, we begin to see a hike in rates. And but if then, again, I like the course that the Fed is taking fundamentally in terms of indicating or making their policy consistent and in response to the data-driven, as they say. All right. So here's this, right? This is the relationships that I want to think about. And, oh, there's another slide before Exhibit A. This is just an overview of the Fed functions. The mandates, if you can read this, I should have blown this up. Mandates, full employment, price stability. That's certainly important based on policy and in a theoretical sense. What the Fed is, they're supposed to try and create an economy within which we have full employment and price stability. More recently, and they've been criticized vociferously in this sense, but they seem to be. I think it's in misplaced or malformed criticism. I think, but according to their formation mandate, but more recently they've been seeming to extend their tentacles into the the global crisis and situation. And but I think what affects the world affects a sovereign state and a particular domestic economy as well. So I think it's apt that they are at least cognizant and taken into context how their monetary policy and how it's informed and its ramifications or repercussions back and forth two ways between what's going on globally. And specifics, specific mandates targeting inflation rate at 2%, that's their policy right now. There tends to be just So you know the, what is it, the Phillips curve or inverse relationship. Rising inflation tends to correspond, you know, I don't know, 75, 77, 80% of the time with lower unemployment. So the heating up of the economy gets heated up and more people go to work. Lower inflation, things are moving in the doldrums, and there's a higher amount of unemployment. That's in turn, so they're taking that into account. Some economists have said, well, that's it's not all that dependable a correlation. It works to some extent. I certainly don't want to attempt to predict interest rates and Fed policy and monetary intervention based on that relationship, but it's a starting point of consideration. I'll give it a little bit of weight. Okay, but here's my thought. Again, fundamentally, I just don't see, in terms of citing some, I think we have still globally had, along with domestically, still weak wage growth. Job growth has been weak. Falling tax returns and receipts, not just here, especially in the U.S., but worldwide. So global destabilization, global slowdown. In the next slide, and I'll just say you as a preview, I'm short oil, and so we've still been having falling commodity prices, as using oil as a proxy for the commodities at large. It's certainly not the only, but it's certainly a critical component of the broader commodity sector. So oil prices have been falling. I think we are in the last stages of a bear market in the oil sector. Nevertheless, we are still in a bear market, and to that extent, as an indicator of potential GDP in the net, it's further incentive, or it would be a further disincentive, I would expect, for the Fed to sooner rather than later raise interest rates. But instead, I think it would be prudent to hold off. So again, I am, in a direct sense, I expect rates to drop, at least on the 10-year note, another 1 to 1.5%. We may end up the year at 2.5% yield on the 10-year note. And I don't think the 30-year will be far behind. So I think in cahoots or consistent or complementary to the ECB, the European Central Bank, the Bank of Japan, etc. I think which worldwide we have been seeing more than for years now, since the 2008, or 2009, since we've been pulling out of this recession. I just don't see that the debt burden has eased sufficiently, and strong enough signs of increasing jobs domestically, increasing rates of wage appreciation. I don't see a sufficient quantitative threshold has been achieved by which that would be tantamount for the Fed to with confidence raise rates. I think it's too soon. There's nothing, the amount to gain is disproportionately small relative to the potential cons of that scenario. So fundamentally, I just don't see it. Now, again, I'm talking on the eve of the report. So let's see what tomorrow's data comes out from the government with respect to last month. We have been things have been getting better, albeit slowly, in terms of job growth, wage growth. But so I just don't. I am making a subtle point. I'm saying the rate with which improvements on wage growth, and acceleration, nominal amounts of job increases, the amounts of tax receipts, again, domestically and worldwide, I just don't see it. But these are just the fundamental factors, I think, at large that the Fed is tending to think about. This is Exhibit A. I just like to think of it because it clearly shows, you can see we have been in a long-term bear market. Now, I'm short oil. We got short oil at 47.77, where we got down as far before I tuned in today, $45 and change. We're 45.80 something, I think, was the low for today. I think we were trading right before I stepped into the presentation at 45.5 or so. So I can see oil prices, testing that $40 area again of support right here. This is $40 or just below $40, $39. I don't know. I know Goldman Sachs and other major investment banks have been calling possibly for $20 oil. I don't see that. I don't know what kind of numbers they're looking at. I know OPEC is continuing to pump, given in an atmosphere of decreasing global demand, but that's not as bearish on this as it might seem on the surface. The added output of production on the part of OPEC, let's say, is to some extent compensating for the loss of production primarily here in the US and other non-OPEC producing nations. So that's kind of tending to move out, or balance out, I should say. One is offsetting the other. I do, however, technically and for other factors, expect another retesting of this $40 area. So we're short from 47 and change, 47.77. We're at 45, 46 in between that area right now. I could see a testing of that $40 area, another $3 to $5 depreciation in oil prices. To that extent, to the extent that we see, and using oil, this is why I call it Exhibit A, more or less as a proxy for GDP. Now, that's an oversimplification, certainly, but I think it's very illustrative of what's going on here. You know, to the extent we use oil, and if I'm correct on my forecast in oil, again, my money's in that market. We're short. We got short, re-shorted this market. We've been shorting for the whole year, but in and out. But basically, to the extent we test and create this double bottom, and if we take it out, then we could see $39, possibly $35 oil. I don't know that that's going to happen. I feel quite confident we could see and test the $40 area. You know, drop another $2 to $3 from where we're currently trading right now. If we're at 45, 45 and a half, we could go down to $43, $42 easily. Another $3, $4 of depreciation in oil prices. And to that extent, as a broad macro correlation, I clearly could see that is an additional bellwether to which the central bank might be looking as an indication of data that they would look at to further disincentivize them from acting sooner in terms of becoming more hawkish on monetary rates. All right. So that's my, this is just my big picture view here in terms of some of the macro interrelationships I'm expecting longer term. Now, okay, euro going up, yen going up, dollar coming down. I'm bullish on stocks through the remainder of the year. Oil currently coming down. Again, let me just to the previous slide here. Oh, if I can pull it up. Back to the previous slide. I expect, but I don't think there's much life left in that bear on the oil, on the energy sector. I do, again, sometimes the devil's in the details, as they say. I am very specific. I don't see much more depreciation in falling. I don't think they're going to offer the price of oil down much below $38, $39. We could get there. I'm not even certain we're going to get there. I can see another $3 to $4 decline in oil prices, though. So that's very specific. It's on a timeline here. Yes, I see oil declining another $3 to $4 possibly to test that $40 zone of critical support. After that, I see that could quite easily correspond to the end of the bear market in oil and the start of a new generic bull market in oil. Okay, and then that could shift things altogether. We start to see a rise in oil, then I'm gonna see a shift. But for now, and by the way, right now, even though this is my longer term view in the bonds, in the nominal treasury and T note, or anywhere on the interest curve, the 2-year, the 5-year, the 10-year, the 30-year, all the way out on the curve. However, whatever section of the curve you're interested in, overall, I'm expecting Fed policy longer term through. When I say longer term, through the first quarter of next year to be accommodative. I don't think I'd be very surprised if we're going to see the Fed raise rates. I just don't see it occurring between now and the first quarter of 2016. And as such, I see appreciation on the nominal, whether it's the 10-year and or the 30-year, clearly. And that's my forecast. We offer a webinar special. Again, Peter Newman, on the inside of our academy, handles all the programs, and we do have raffles and contests and incentives. Basically, if you're interested in our mentorship, you'd get a 1-month one-on-one membership. It's valued for free. If when you fill out the survey, if you happen to be the winner of the raffle, I think every 2 or 3 months they do the raffle, and we get a fortunate somebody out there who's interested gets a 1-month mentorship, either with myself or one of my coworkers. We currently have 3 other mentors. We're looking to bring in another mentor right now. We just had a gentleman go. So if you have an interest in that, fill out the survey and submit your contact information so we can submit you to the raffle. And if you win, you win. And great. Now, folks, I have certainly, and again, Peter Newman is our person that would answer questions on that or anything related to any of the programs. I certainly, again, did not this is not, I do webinars from time to time where I provide more instruction on a specific, say, technique or indicator or idea or model, be it Elliott wave, be it Gann analysis, be it trend analysis, be it some mathematical formula that I might have come up with, or an oscillator, or any analytical part of the componentry of this business. Every now and then I do programs on that. It's hard in the course of when you've got 100 people or more that sign up for a program, and how do you generalize, or how do you make specific? Everyone is, again, at a different level, has different interests, but it's suffice it to say, the only thing I don't teach, not because I don't have experience, I don't currently teach trading via solely the fundamental approach. And I always jokingly tell people, and the students I work with and the traders that I consult currently, I started my career, the very first book I read was Fundamental Analysis by Benjamin Graham, Dodd, Cottle, and Tatham. It's the Bible of the fundamentals. That was, again, when I was 24 years old, more than 34 years ago. But I primarily focus and utilize a technical approach incorporated with my market timing. But I'm open to anything. My first mandate, of course, is to maximize and optimize financial returns. But aside from that, so here's the reason in saying all this. To the extent, if you're getting started, maybe you're not as familiar with any specific models or concepts or indications or relationships that I was alluding to in the presentation today, that's why ask questions and I'll be happy to elaborate more specifically. But the primary intent was not to focus in on a specific topic and present a tutorial on that topic. That's what we do, and that's what I do in teaching one-on-one, so I'm certainly happy to. I just wanted to more or less present an overview in terms of my forecast for interest rates in the Treasury sector. So guys, I'm done. Any questions? If you have any questions on my forecast, the market, or anything related, I'm happy to think or address them. Thanks again. Thank you, Hector, or HEC, whoever that is. I appreciate your appreciation. But certainly, I've got a couple of minutes. We have recorded today's presentation. If you'd like to review any portion of it, or if you came in late, the recording you can access by contacting the folks at Pacific Trading Academy. You have access to our archives, where we basically record and upload all of our webinars. Any questions for the moment, though? I'm happy if you have any. If you have dissenting opinion, if you have a comment, if you have a question, any or all of the above, we have time. I'm glad that normally I go way over, but I think I'm only about 7 minutes, or actually, if we started about 3 minutes after, I'm only about 4 minutes over. So great, still here. Thank you, Roy, for being here. Thank you, folks, Stephen, Hector, anyone and all who's there. I appreciate you showing up. It's always a pleasure to get you to know that there's someone out there. And if you have feedback, it can be negative. I am looking for any positive criticism by which we can improve our presentations, or if you have a different view. I want to, the process of investing in speculation is one of thoughts and information in a realm of probability. So I'm always looking to improve my understanding and teaching and trading. So certainly if you have questions, I'm open to that, or any comments. If not, it doesn't look like we have anything. Well, folks, it's been a great, once again, to present my latest research findings, and I think you have a good idea of what I'm expecting in the bond market and interest rates in particular. On that note, we'll call it a day, and I wish you, in the meantime, until we meet again, a great day, and wish you profitable trading in the days and weeks and months to come. Until next time, have a great day. Bye-bye.